Oh, hi, everyone. Welcome back to the chapter 3. So I think you guys can see the screen right now. So you have a two button, you can switch back and forth. Maybe I will show you guys in the class. Okay, so we in the chapter 2 we talk about the how to recording transaction with external parties, and this chapter we're trying to figure out how to recording, adjusting entries, and how to generating financial statements, and how to closing temporary accounts. Um, what is called temporary accounts, and how to closing them for the period. Okay, and same thing is that this chapter is gonna split into three sections. First section, we want to talk about what's the difference between accrue and cash accounting. That we can introducing you why do we need to have adjusting entry? Why do we need to closing the book? What's the difference between external and internal journal entries? And the second part of the recording is gonna focus on specific transactions that's gonna cause the difference between accrual accounting and cash accounting, and what is the timing differences between the cash recipient and the business activity, and why those time differences can cause we needed to do adjusting entries. And third part of the third section of the lecture is that I wanted to introduce you guys how to using adjusted trial balance. Remember in chapter 2 we have a trial balance, but those balances is only recording the transaction with outside or external transactions, or one part of the transaction is interacting with outside. And but during this chapter we wanted to talk about how to recording the financial accounting statements and records according to GAAP, right? Generally accepted accounting principle. Hence, that the third part of the chapter is trying to compile a balance sheet, income statement, and the stockholder equity statement. And the last part of this chapter is going to talk about closing entry. How do we closing those temporary accounts? Why income statements, all the accounts on the income statement start with a zero balance, okay, on the new period, and all the accounts on the balance sheet have a accumulating or carrying balance. Okay, so without further ado, I just briefly talk about what's going on with the chapter 3, and let's dive in. Okay, okay. So starting with the part A of a measurement process, we wanted to introduce you the idea about what is the accounting cycle. Okay, so let's say the accounting cycle right now we're talking about a whole year and a calendar year. We're starting from January 1st to December 31st, and December 31st is end of the year. So during the year, we record and post external transactions, which is chapter two's emphasis, right? So, um, and then end of the year, we wanted to recording and post adjusting entries, and then this is our learning project for chapter 3, object 3 and 4, and we call this adjusting process. And then once we understanding the adjusting entries, then we wanted to be able to prepare the financial statements, and we call those reporting process, right? So we are having a measurement process, and then we are reporting and communication. And in the end, we want to closing the books and get ready for the next period. Okay, so there's a whole step, right? External measurements, adjusting entries, financial statement communication, and a closing entry prepare for the next period. This whole process is called accounting cycle. Okay, so we wanted to first starting with understanding when the revenue and expenses are recorded. Okay, the most important thing, which is the biggest regulatory changes during 2017 to 2019 till now is basically revenue recognition principle. Revenue is, of course, is recorded in the period in which the goods and services are provided to the customers, right? And we call this revenue recognition principle. And then how do we recognize expenses? Expenses is any costs used to help us to generating the revenues are recorded in the expense in the same period. I just wanted to emphasize that this is the same period. Let me use a pen. Okay. Okay. So let's see. This is the cost, right, used to help the generating revenue in the same period, okay, as those revenues. So matching expenses with revenue. So there's something we call the matching principle, meaning that the things generating the revenue need the matching side of the expenses. So basically 100 revenue is generated by $50 of expenses. And then this you have to match the generated revenue with the expenses. And that's we call the matching principle. With the revenue that helped generating allow net income to provide a more useful information about the company's operating performance. So what kind of things where actually the matching principle should apply, but actually in the reality it might not happen that way. For example, in the chapter 2, we talk about when the company offered the soccer training and then they collecting the cash at the beginning of the training session and then gradually offer the training accordingly, right? So in the time of that, the training services was not provided but received the money. And that time, we cannot recognize as our revenue. Instead, we recognize it as a liability. That's exactly what we talk about, right? Although we know this is part of a revenue, but we haven't earned, meaning that the training services has not been provided yet. Hence that this part of the revenue did not have the corresponding expenses such as the coach's salary to generating this pre-received training revenues. Hence, this matching principle tells us that if you have this kind of situation, the pre-received revenue should not be recognized as revenue, right? And we will talk about in details. Okay, so the key points here is that the revenue recognition principle states that, right, this is most important thing, states that the revenue is recognized in the period in which the goods and the services are provided to customer, not necessarily in the period in which we receive cash, right? So there is a difference. So cash is not the indication of receiving revenue. Okay, so that's why there's a cash is not all. There's a difference between cash and accounting essence, right? Okay, and then most expenses are recorded. Most expenses, yes, whenever you have expenses, you should always recording at the same period of the revenue that they help to generate. But there is a certain things that you spend it in the beginning, such, right? And then you haven't even enjoyed the benefit that it brought to you to producing the revenue. Hence, there's a difference between the cash outflow because you're generating some kind of expenses, but it has not served you to generate revenue yet. Those kind of expenses not supposed to be recorded in the current period either. Okay, so now then we're understanding there's something difference between accrue accounting and the cash accounting. Let me elaborate a little bit more. So we want to do a comparison between accrue basis and the cash basis accounting. So the point of the difference is when we have a revenue recognition, when do we recognize revenue? When we receive cash, or will we really have a period of goods and services being provided to the customer, right? So on the accrue basis, in the period of goods and services are provided to the customers, we recognize revenue. However, on the cash basis, we recognize revenue immediately when we receive cash. Okay? And the expense recognition, under accrue-based accounting, we will record the cost in the period the costs are presumed to have been used, right? So regardless whether we spend that cash for the expenses, as long as we presumed to have been used, then we record expenses. And the example I want to give you is depreciation expense. I don't want to elaborate too much here, but in chapter 4, I think we will elaborate a lot about why do we record depreciation expenses, why is that important. Okay, on the cash basis, yes, expenses are recognized at the time that we pay cash, right? So, what kind of principle is acknowledged or used by generally accepted principle? Of course, accrue-based is part of GAAP, and cash basis is not part of the GAAP. Okay, so always, as I mentioned before, the answer is going to be provided right after so I'm writing here just trying to draw your attention. Okay, so let's do some example. Let's see this one. So let's say December 12th, there's a description of the transaction. It's providing soccer training to customer for cash for 4,300. So shall we say, first of all, the economic essence is the service provided. Yes, right? So it says providing soccer training to customer for cash. So service is provided. So if we are already providing services, regardless whether we receive cash, we should recording the revenue, right? So we should record 4,300 here. And cash basis, should we record this revenue? Okay, then the question is there cash received, right? Oh, okay, so we did receive full cash, 4,300. Oh, okay, we received cash. And then on the cash basis accounting principle, of course, this portion of the revenue should be recognized, right? Okay. Okay, so we did it. Okay. Second, December 17th, provide soccer training to customer on account. Okay, is this training services provided? It says it's providing soccer training to customer. Okay, it is provided. Okay, yes, it's provided. So shall we recognize revenue? Yes. As long as we're providing services, we should recognize revenue. Okay, on the cash basis, it says providing soccer training to customer on account for 2,000. Does that mean that cash is not received? Yes, cash is not received. Hence, cash-based accounting is not gonna recording $2,000 as revenue. Hence, there is 0. Okay. Or deferred revenue until cash is received. Okay. December 23, receive cash in advance for 12 soccer training session and to be given in the future. Okay, this means that we receive money, but we have not given the services yet, right? Hence, in terms of accrual accounting, service provided not? No, service hasn't provided. Hence, we will defer the revenue recorded for the future period when we earn. But what if we use cash basis accounting? Okay, because we already received how much? $600, right? To be given. So we already had the cash in advance. So yes, cash based, this is considered a revenue. And we record $600 here. Okay? Okay. You can look at the examples. Okay? Okay. So accrue basis expenses versus cash basis examples. Okay, transaction 1. December 1st paid a 1-year rent in advance for $6,000 but $500 per month. Okay, so December 1st you paid a whole year's rent in advance for $6,000, but you know it's only $500 a month. Hence, if we are using accrue-based accounting, is this expenses should be recorded? No, right? Because we did not start living there. We just paid rent in advance. We haven't enjoying the rent expenses. Hence, this is gonna be deferred to when we enjoy the the rent. When we live in there, the time expire month by month, and we pay 500. We recognize $500 per month as recorded rent expense. And then cash-based accounting, of course, we pay the cash, right? The cash basis is like if you have paid out cash, you have to record it. If we're using, yes, cash paid, and paid $6,000. Okay, right? Okay, December 6th, purchase supplies on account for 2,300. Okay, then you will be like, okay, purchase the supplies. Did I use the supplies? It didn't say, so that means we didn't, right? We didn't use the supplies. Hence, there will be 0 deferred expenses if we are using accrue-based accounting. But of course, if a cash-based accounting, we purchased already, right? We purchased it. Of course, we have to record the expense and record 2,300 expense. Okay. Oh, sorry. It says on account. Pardon me. I need to change here. So that means this is no, because I thought yeah, 0. Okay. And then, okay, here, pay salaries to employee for 2,800. I think, yeah, this is yes, because when we during the year and we pay the salary for the employee, of course, the employee already performed their duty. And this is expense to record is 2,800. And of course, if you paid salary, that means cash outflow, you will record 2,800. And this one, remember, on account. Okay. Okay, so the difference we wanted to take away from this is that the difference between accrue accounting and cash accounting is that the timing, right? Timing. The cash accounting always chasing for cash. Whenever you receive cash, no matter it's inflow or outflow, I record it. If it's outflow, I record it as expense. If it's inflow, I record it as revenue. But accrue accounting is different. Accrue accounting does not chasing cash. Accrue accounting chasing for economic essence of the transaction. Okay. Under accrue accounting, we record revenue when we providing the goods and services to the customer, when we instantly earn that money, and we record expenses when the cost is used in company of the operation. We only record expenses when we find we have a company revenue being recognized, right? But on the other hand, like on the cash accounting, we record the revenue when receive cash. We record expenses when we pay cash. Hence everything, as long as cash, you're chasing after cash. Cash-based accounting is not allowed for financial reporting purpose for most majority of companies, right? So if you are a public company, you definitely cannot use cash-based. But other private company, mom and pop shop, sometimes they using cash-based. Majority time they use cash-based, which is, I don't think it's a way of recording, but it's not a way of very scientific way for recording your book. Okay. Okay, so let's do some concept check. So which of the following would be recorded as expense under accrue basis accounting? Okay. A, the company purchased office supplies with cash and does not using the supplies. Okay, so this is asking you in under accrue basis, which one of the choices is being considered as expense? A company purchased office supplies with cash but did not use it. It's already told you it's not using it, hence not this one, right? B, the company use utility, great, this is key words, in the current period but does not pay for cash. We talk about, we don't care about whether you pay cash or not if you are using accrual basis accounting. Hence, this must be expense. Okay, C. The company provides services to customer for cash. This is, to me, it's under accrual basis. It should be recognized as revenue. But this question is asking expense, right? How do you record expense? D. The company purchased equipment by borrowing from the bank. This is not about, this is a long-term asset which is benefit you in the future period, hence it's not going to be expenses, right? Yes. Okay, the choice is B. Okay, so concept checks 3.3. Which of the following would be recorded as expense under cash basis accounting? Okay, so that means that if we see cash outflow, we know cash base is gonna recognize as expense. So company purchase office supply with cash does not use the supplies. Okay, that would be one, because it's regardless, on the cash basis, it's regardless whether you use or not, but it used the cash, right? It used the cash to purchase it. So that's why it's considered as cash-based expense. B, the company used utilities in the current period but does not pay, so no cash outflow, hence it's not being recorded. C, the company provides service to customer for cash, so this is actually cash inflow, so it's not expense. The company purchased equipment by borrowing from the bank. As we said, the equipment is an asset, right? It's not expenses. Okay, answer is A. Okay, so let's use another video to talk about how do we recording those adjusting entries. Since we already established the concept between cash accounting and accrual accounting. Okay, see you on next video.